If your insurance feels responsible, but your money still feels tight, something important is being missed. A lot of people are not losing money through recklessness, but through polished protection habits instead. That is why this problem hides so well, because it wears the costume of adulthood perfectly. It sounds like planning ahead, protecting your family, and refusing to leave important risks uncovered ever. But insurance can become one of the cleanest ways fear quietly empties your paycheck every month. Not because insurance is bad, but because unexamined protection gets expensive faster than most people realize. Once a premium becomes automatic, people stop asking whether it still deserves a permanent place there. They assume more coverage means more wisdom, lower deductibles mean more safety, and loyalty means fairness. Sometimes those things are true, but often they are just expensive stories that soothe the uncertainty temporarily. If you have ever paid for coverage and still felt anxious, you understand the deeper issue. The problem is not only the policy, it is the emotional habit sitting underneath that policy. That habit usually sounds smart. I just want peace of mind and fewer financial surprises later. I would rather be safe, and sorry sounds responsible, until nobody defines what safe actually costs. By the end of this, you should see the difference between real protection and panic protection. Between useful coverage and emotional overcoverage, between policies that support your life and compete with it. Because the question is not whether you have insurance, but whether fear built your strategy instead. That matters even more when your budget feels squeezed by housing, food, debt, childcare, and gas. When money feels tight, people usually examine coffee, subscriptions, and takeout before anything else in detail. Not in wild spending, but in innocent habits repeated for years without review or comparison shopping. Like choosing the smallest deductible because bigger numbers feel emotionally threatening even when savings could absorb. Like adding every optional rider because saying no feels careless even when the risk is tiny. Like staying with one insurer because switching feels exhausting, suspicious, or strangely disloyal to adulthood itself. Like bundling home and auto coverage and assuming the discount automatically means the total is competitive. Like insuring a car so heavily that the premium starts acting like another car payment entirely. Like buying permanent life insurance before you have emergency savings, retirement momentum, or stable monthly cash. Insurance is sold in language designed to trigger caution before it triggers calm analysis in you. Protection, premium, guaranteed, umbrella, lifetime, family, replacement, security all sound reassuring long before math enters conversation. They speak directly to your fear of regret, and regret is expensive in monthly installments forever. People will overpay for years just to avoid imagining one painful future scenario happening to them. The first innocent habit is treating every possible risk like it deserves a monthly payment plan. It does not, because some risks should be insured and some should be self-funded instead sometimes. Some risks should simply be accepted as part of adult life without paying to erase them. That is not recklessness, it is financial maturity and a better use of limited cash flow. If a loss could seriously destabilize your finances, insurance deserves strong consideration and careful comparison first. If a loss would be annoying but manageable, another premium is not automatically the smartest move. People buy coverage for manageable problems because small fears feel vivid, immediate, and easy to picture. This is where healthy caution and fear-based caution separate, and the difference changes your entire budget. Healthy caution protects you from losses that could materially disrupt your life or household stability seriously. Fear-based caution charges you monthly to soothe discomfort you never properly examined or priced honestly beforehand. Healthy spending is intentional, while emotional spending is relief with a receipt and lingering regret afterward. Insurance can absolutely become emotional spending when extra coverage feels like buying certainty for your nerves. But certainty is not what most policies actually provide. They provide limits, exclusions, delays, and trade-offs. Bad insurance decisions rarely hurt in one dramatic month. They hurt through repetition and silent compounding. $40 here, $60 there, one rider, one add-on, one penalty, one unnecessary comfort fee monthly. That is why automation without review becomes expensive, not because insurance is evil, but because defaults. Car insurance shows this problem clearly because many people set coverage during stress and never revisit. They leave the dealership with a payment, full coverage, gap insurance, service plans, and extra protections. Every add-on feels minor because the whole purchase already feels emotionally overwhelming and time-pressured that day. I have seen modest used vehicles insured so heavily the premium behaved like a second payment. And often the reason is not math, it is identity and fear of appearing careless publicly. So they are not only buying protection, they are buying distance from shame and social judgment. Distance from feeling underprepared, from looking irresponsible, and from the fear of future self-blame later. That is why one simple phrase matters so much when pressure shows up financially around you. That payment is too high, and you can say it calmly without apologizing to anyone there. If the premium is pressuring your budget, lower deductibles might not actually be protecting you financially. They may just be converting manageable risk into guaranteed monthly strain, and guaranteed strain is risk. Not every safe option is actually safe over time, especially when cash flow keeps getting squeezed. A lower deductible feels safer because the possible out-of-pocket shock looks smaller in your imagination today. But if the higher premium stops you from building savings, your overall position gets weaker anyway. Sometimes the smarter move is accepting more deductible risk while strengthening the cash buffer behind it. Protection is not what your policy promises. Protection is also what your balance sheet can absorb. The second innocent habit is loyalty without price testing, which insurers understand extremely well and exploit. They know people hate paperwork, hate changing providers, and hate reopening decisions that already feel settled. So many customers stay because staying feels easier than thinking, comparing, or making another adult decision. Meanwhile, premiums drift upward, discounts change, and better offers go to people willing to compare quotes. Your insurer may not be rewarding loyalty, they may be monetizing your reluctance to leave them. People often assume good behavior naturally earns better treatment, but sometimes it simply earns quiet neglect. That is why one of the most useful personal finance phrases is run the numbers first. Not trust the familiar logo, not trust the reassuring agent, and not trust habit alone ever. A familiar company is not a financial plan, and a habit is not a real strategy. If you have not compared quotes in years, you do not know your actual market cost. You only know your current cost, and those are not remotely the same thing, financially speaking. The third innocent habit is overinsuring low-value problems while underinsuring risks that could really hurt you. People focus on losses they can picture quickly, and ignore losses that feel abstract or heavy. So they protect phones, packages, appliances, travel hiccups, and store purchases with tiny coverage decisions constantly. But they neglect disability protection, adequate liability coverage, and the cash reserves that make insurance smaller. Small losses feel vivid, while big losses force uncomfortable thoughts about illness, lawsuits, incapacity, and income. That is emotionally heavier, so people postpone it and keep spending money solving the wrong problem. It is like locking every kitchen drawer while leaving the front door wide open at night. If your income supports your household, your ability to earn is one of your biggest assets. If you own assets, liability risk deserves real attention because lawsuits do not care about optimism. If others depend on your income, life insurance matters more than another extended warranty ever will. This is not an argument for buying every major policy. It is about ranking consequence correctly. Align coverage with financial consequence, not with whatever fear happens to feel vivid that particular week. The fourth innocent habit is confusing bundling with optimization, which happens constantly because convenience feels smart. Bundling can save money, but bundling can also hide bad pricing inside a very clean package. One company, one bill, one login, one agent, and one less thing to think about monthly. If one policy inside the bundle is overpriced, the discount can create a convincing savings illusion. People proudly say they got bundle deals, then never check whether separating policies would save more. That is when another useful phrase helps. The math does not support that at all here. You do not need a dramatic speech. You just need enough calm to trust the math. The fifth innocent habit is choosing deductibles so low they quietly block wealth building somewhere else later. This hits especially hard when households are trying to escape paycheck-to-paycheck pressure and rebuild breathing room. Low deductibles feel like control because they reduce possible pain later and shrink scary numbers today. But they can raise guarantee pain now, and if cash flow is tight, the present matters. Sometimes cash flow matters more than pride, and sometimes flexibility matters more than theoretical smoothness later. Sometimes the smartest money decision is psychological first and mathematical second, because behavior still drives outcomes. If a higher deductible would force you to finally build a real emergency fund, that matters. If a lower deductible keeps you calm but permanently short on cash, that matters too financially. Sometimes refusing a higher deductible is not caution. It is evidence your foundation already feels unstable. That is important information, and your job is not to hide from it or sanitize it. Your job is to use it, build the cash reserve, then choose coverage from stronger ground. The sixth innocent habit is letting the dealership shape your insurance thinking during one stressful day. Car buying overloads your brain with price, financing, trade-in, timing, features, monthly payment, and identity pressure. That is when people start saying yes just to end the pressure and escape the room. Yes, because the monthly increase seems small, and because saying no feels reckless or irresponsible somehow. But small monthly add-ons become large long-term totals, especially when stacked on a financed vehicle already. A person can buy a car to look stable, insured in ways that create instability. That is one of the most common middle-class traps in America, because cars carry status weight. The car becomes a symbol of adulthood, then financing, insurance, taxes, maintenance, and depreciation consume options. You need another phrase here. I need flexibility, not pressure, not another payment, shrinking my options. That phrase can save thousands because qualification is not affordability, and approval is not a plan. Affordability is what remains after the payment, premium, upkeep, and real life collide in 1 month. The seventh innocent habit is buying life insurance as an investment before understanding your real priorities. Life insurance gets emotional fast because it mixes love, fear, responsibility, and uncertainty in one conversation. That makes people vulnerable to complexity, and complexity often benefits the seller more than the buyer. For many households, term coverage plus disciplined saving and investing is enough to protect what matters. Protect income while dependents are vulnerable, build assets over time, and keep costs reasonable from start. But many people get sold expensive permanent policies before they have emergency savings or retirement momentum. Cash flow is already tight, high interest debt still exists, and retirement accounts remain underfunded for years. Then a large premium arrives, wearing sophisticated language and the promise of feeling financially serious sooner. This does not mean permanent insurance is always wrong, because real nuance matters in personal finance. But if a complex policy crowds out simpler priorities, the sequence is wrong from the start. Sequence matters because what you fund first changes what becomes possible later when life gets expensive. The eighth innocent habit is treating insurance review like a crisis task instead of a calendar. Most people revisit policies only after something hurts, like a rate jump, denial, storm, or accident. Everything drifts, subscriptions drift, lifestyle drifts, spending drifts, and insurance drifts with your changing life too. Your assets change, your savings change, your driving record changes, and your risk capacity changes too. So the right question is not whether you have insurance, but whether it still fits today. That mindset turns insurance from background noise into an active decision that deserves periodic mathematical review. The ninth innocent habit is using insurance to compensate for weak savings and thin liquidity reserves. When people do not trust their cash reserves, they try outsourcing every inconvenience to a policy. Lower deductibles, extra riders, broader coverage, add-ons, anything that avoids touching savings that already feel fragile. But the long-term fix is usually not more insurance. It is more liquidity and better structure. If every small setback needs corporate intervention, your financial system is already too fragile to breathe. A healthy household can absorb some shocks directly, which reduces the need to pay others monthly. Insurance should handle bigger risks, while savings should handle smaller disruptions that happen in normal life. When those jobs get confused, premiums expand and resilience shrinks, which leaves you paying more overall. The 10th innocent habit is mistaking emotional relief for financial wisdom right after buying coverage anywhere. People often say, I feel better now, as if feeling calmer proves the decision was smart. People buy bigger houses for peace, expensive cars for peace, and extra coverage for peace too. What looked like protection becomes stagnation, and stagnation is expensive because money grows through retained capacity. Capacity to save, capacity to invest, Capacity to invest, capacity to absorb surprises without unraveling or borrowing from tomorrow. Every unnecessary premium competes with that capacity, which means every small overpayment quietly steals future options. So ask 3 brutally honest questions before accepting any coverage as obviously necessary in your life. What specific financial disaster is this policy actually protecting me from, and how severe is it? If that event happened, could I absorb some or all of the cost myself realistically today? What is this premium preventing me from doing elsewhere, like saving, investing, or reducing damaging debt? Those questions force clarity, and clarity is exactly what fear hates, because clarity demands numbers back. Fear prefers vague danger, while clarity asks for probability, cost, consequence, and a clear trade-off assessment. That is where real financial adulthood begins, not when you buy more products or sound sophisticated. Maybe the answer is keep the policy. Maybe it is reduce the rider or shop competitors. Maybe it is raise the deductible and build cash. Maybe it is not right now either. Not right now is a powerful phrase, because refusing pressure is often the beginning of strength. That does not fit my plan is another useful phrase, especially when somebody sells fear aggressively. You do not owe long explanations, because financial boundaries get stronger when you stop over-explaining them. Pause before buying, wait one day, and look at the full yearly cost before saying yes. Review the deductible beside your emergency fund, not in isolation, and ask how claims actually work. Every optional protection is also an optional drain unless the risk truly warrants the ongoing cost. Here is a real example. Someone buys a 3-year-old sport utility vehicle that feels family-ready immediately. The payment already feels high but manageable, then the insurance choices start quietly stacking pressure upward. They choose a very low deductible because a big bill feels emotionally intolerable even before analysis. They add roadside help, rental reimbursement, windshield coverage, and dealership gap insurance without comparing outside options. Individually, none of those choices seem outrageous, but together they turn a reasonable vehicle into constraint. Now the household struggles to build savings. One repair creates stress, and one school bill hurts. They do not feel over-insured, they feel unlucky, but the real issue is structural and predictable. Too many fear-based decisions were stacked together, and the system never had breathing room to begin. Here is another example. A couple buys their first home and wants to do everything right. They increase coverage everywhere because homeownership suddenly feels fragile, serious, and financially unforgiving overnight somehow. They insure valuables generously, pick a low deductible, and add water backup, mine and identity protection. Some of those coverages may be useful, but nobody asked the bigger cash flow question first. Which risks would truly hurt us, and which risks would simply upset us without lasting damage? A house already creates enough volatility through maintenance, utilities, taxes, and unpredictable repair timing every year. If insurance choices leave you unable to handle normal ownership friction, you are not more protected. You are more brittle, and brittleness feels like anxiety all year because cash flow stays tense. Real resilience is not buying every shield someone offers. Real resilience is knowing which hits matter. It is knowing which hits are survivable and which prices are simply too high to accept. That mindset changes more than premiums. It changes how you think about money and uncertainty itself. You stop using products to manufacture emotional certainty and start building systems that can tolerate uncertainty. That confidence is calmer, cheaper, stronger, and much harder for the marketplace to manipulate or exploit. Because manipulation usually sounds like this. Something bad could happen, so buy this right now quickly. Smart money decisions do not come from panic. They come from proportion, probability, consequence, and trade-offs. What is the real probability? What is the real cost? And what consequence actually changes life? What am I paying every month to avoid feeling uncertain? And is that price worth it? If you can answer those questions, you stop being easy to sell or pressure financially anymore. Many insurance habits were inherited, not chosen, because parents taught caution and fear taught compliance early. Adulthood then taught that responsible people keep saying yes to protection whenever uncertainty enters the room. So questioning those habits can feel uncomfortable, almost guilty, like reducing coverage means becoming reckless somehow. It does not. It means you are finally distinguishing between being protected and being pressured emotionally. That is a major financial upgrade, especially if you have spent years feeling behind and reactive. Feeling behind makes people vulnerable to overcorrection, and overcorrection often looks like buying structure too quickly. They buy products before understanding sequence, pay complexity before building basics, and confuse more with better. But more is not always better. More can mean heavier, slower, and far more expensive later. More can mean less freedom, less margin, and more quiet financial fatigue hiding inside respectable choices. Quiet financial fatigue is dangerous because it rarely gets dramatic enough to force change quickly enough. It just trains you to believe life is more expensive than it actually needs to be. Then you stop saving aggressively, delay investing, accept pressure as normal, and wonder why progress stalls. Not because you were irresponsible, but because you were responsible in ways nobody properly examined before. But they quietly sabotage flexibility, which is one of the most valuable forms of financial strength. Flexibility lets you leave bad jobs, absorb rate hikes, handle repairs, and invest during market fear. Insurance should protect that flexibility, not consume it until your life feels permanently crowded and tense. So if this hit a nerve, good, because finding a leak is the beginning of repair. Start with one review, one policy, one premium, one deductible, and one completely honest question today. What am I truly protecting, and what am I merely paying to feel less uncertain temporarily? That single question can save you more than another budgeting trick, because it attacks the wheat. Better money decisions are rarely about punishment. They are about seeing clearly what each dollar buys. Seeing when caution is wise, and when caution is just fear with better branding on it. You do not need perfect instincts. You need a calmer process that trusts numbers over pressure. And you need to remember every dollar has a job, including the dollars you send insurers. If an insurance dollar is not protecting something important, it should probably stop leaving your account. Because financial peace is not built by paying for everything, it is built by understanding enough